Silver is done. China's shock move. Explained, somewhere inside a boardroom in Beijing, a decision was made that could quietly unravel one of the oldest financial illusions in modern history. No press conference, no warning to Western markets. Just a single calculated move, and the countdown began. Right now, banks are closing doors that have been open for decades. Investors are being told to walk away. And somewhere, far from the spotlight, the foundation of $1 trillion market is starting to crack. What happens next could change how the entire world values silver forever. Welcome back to Precious Metals Intelligence, the channel built for those who prefer facts over noise and strategy over speculation. Whether you're a seasoned investor, a business professional, or simply someone who values understanding how global power really moves behind closed doors, this channel exists to give you clarity in a market designed to confuse. Before we continue, we'd love to know, where in the world are you watching from today? Drop your city or country in the comments below. It's always remarkable to see just how global this community has become. It started with a simple announcement. No headlines, no breaking news alerts, just a quiet update from one of the largest banks in the world. The Industrial and Commercial Bank of China, known simply as ICBC, told its customers something unusual. Retail investors could no longer trade precious metals the way they used to. Leverage trading through the Shanghai Gold Exchange was being suspended. Customers were given 3 choices: close their positions, sell their holdings, or take physical delivery of the metal itself. That was it. No long explanation, no detailed report, just a short notice, buried in official language, telling ordinary investors that their access was ending. For most people watching the news that week, this meant nothing. It looked like a routine banking decision, the kind of thing that happens quietly and gets forgotten within days. But for those who study global finance closely, this was something else entirely. This was a signal, and signals like this are rarely accidental. Within days, mobile banking access for these accounts went dark. Online trading platforms stopped working for retail clients. Bank branches turned customers away when they asked about their positions. It was not just one policy change. It was a full shutdown of an entire system that had existed for years. And ICBC was not acting alone. Other major banks across China followed the same pattern almost immediately. They stopped accepting new customers. They closed accounts that had been sitting unused. They returned deposits that people had left behind. And on some products, they raised the cost of trading so high that it no longer made sense for ordinary investors to participate. Margin requirements, the amount of money needed just to hold a position, jumped as high as 140% in some cases. The official reason given was simple: volatility. Markets had been unpredictable. Prices had swung wildly in both directions. Banks said they were protecting everyday investors from unnecessary risk. On the surface, that explanation made sense. Silver and gold prices had indeed moved sharply that year. But for anyone paying close attention, the timing raised a deeper question. Why would the world's largest bank, one that manages trillions of dollars, suddenly decide that ordinary people should not be allowed to trade metals anymore? Why now? And why across so many banks at the same time? Business professionals who study economic policy know one thing well. Large institutions rarely make major decisions based only on short-term events. They plan ahead. They study patterns years in advance. When multiple major banks move in the same direction at the same time, it usually means something bigger is happening behind the scenes, something that has little to do with a single month of price swings. This is where the story becomes interesting, because this was not the beginning of China's retreat from precious metals trading. It was the final step in a process that had been unfolding quietly for years. Small changes here, restricted access there, a slow tightening of the rules that most people never noticed because each step seemed small on its own. But when placed together, a clear pattern begins to appear. A pattern that suggests something important. China was not simply protecting its citizens from short-term risk, it was systematically removing itself from a system it no longer wanted to be part of. And this raises a much bigger question, one that reaches far beyond China's borders. If the world's largest bank is pulling back from paper trading in silver, what does that mean for the rest of the world? What does China see coming that other markets have not yet priced in? For decades, silver has been traded mostly on paper. Contracts, promises, and claims that rarely involve anyone actually receiving physical metal. This system has worked quietly in the background for years, largely unnoticed by everyday investors and business professionals alike. But if one of the largest financial institutions on Earth is choosing to step away from that system, the reasons behind that decision deserve serious attention. Because history has shown time and again that when large, cautious institutions begin quietly protecting themselves, it is rarely without reason, and what comes next may explain exactly why this matters. Not just for investors in China, but for markets, industries, and decision-makers around the entire world. Imagine a small business selling shares in a warehouse full of gold bars. Except there's a catch nobody mentions up front. The warehouse only holds enough gold for one out of every few hundred shares sold. Everyone believes they own a piece of something real. Few ever ask to see it. Fewer still ever try to collect it. And for years, that arrangement works perfectly, right up until the moment too many people ask for their share at once. This is not a hypothetical story. It is close to how much of the global silver market has actually functioned for decades. To understand why China's recent moves matter so much, it helps to understand a basic difference that most people never think about. The difference between paper silver and physical silver. Physical silver is simple. It is a coin, a bar, or a piece of jewelry that a person can hold in their hand. If someone owns it, no one else owns it. There is no confusion about who has the metal. Paper silver works differently. It is a contract. A promise on a piece of paper, or more often today, a number on a screen, saying that someone has a claim to a certain amount of silver. On major Western exchanges, these contracts can be bought and sold freely, often without anyone ever touching or even seeing the actual metal. Here's where it becomes interesting. On these exchanges, the number of paper claims on silver can vastly outnumber the amount of physical silver actually sitting in vaults. Some estimates suggest that for every 1 ounce of real physical silver, there may be hundreds of paper claims pointing to that same ounce. Think of it like a concert venue that sells far more tickets than it has seats. As long as most ticket holders never show up expecting a seat, no one notices a problem. The system runs smoothly. Prices move up and down based on how many tickets are being bought and sold, not on how many actual seats exist. But if a large number of ticket holders suddenly decide to show up and demand their seat, the entire illusion collapses very quickly. This is essentially how much of the paper-silver market has operated. Traders buy and sell contracts every single day. Prices rise and fall based on this trading activity. But only a very small fraction of these contracts, often less than 1%, ever result in someone actually receiving physical metal. The rest are simply closed out, rolled over, or settled in cash. For decades, this system has allowed a small amount of physical silver to support an enormous, fast-moving paper market. It has also given large financial institutions significant influence over silver's price, since the price is being set mostly by paper trading activity rather than actual physical scarcity. Now here is where China enters the story in a different way. Unlike Western exchanges, the Shanghai Gold Exchange was built on a different foundation from the very beginning. In China's system, if a person wants to hold a contract for silver, they generally need to back it with real physical metal. This is a fundamentally different structure. It does not allow the same kind of enormous gap between paper promises and physical reality. This difference matters enormously right now, because as China pulls back from allowing ordinary investors to trade leveraged paper contracts, it is effectively pushing its own citizens toward physical ownership instead. Coins, bars, and other tangible forms of silver rather than contracts and promises. For business professionals and serious investors watching global markets, this shift deserves close attention. When a major economic power begins favoring physical assets over paper claims, it often signals a deeper level of caution about the financial system as a whole, and it raises an important question that will only grow louder in the months ahead. If China is quietly moving away from a paper-based system and encouraging real ownership instead, what happens to a global market that still depends heavily on paper promises to set its prices? The answer to that question may not arrive immediately, but the direction is becoming difficult to ignore. A structure built for decades on trust, convenience, and quiet assumptions is beginning to face pressure from a country no longer willing to play by the same rules. And that pressure, however quiet it seems today, tends to build for a reason. Big changes rarely happen overnight, even when they appear that way on the surface. Most of the time, what looks like a sudden announcement is actually the final chapter of a much longer story, one that unfolded slowly enough that almost nobody noticed it happening in real time. That is exactly the case here. The recent restrictions placed by Chinese banks on precious metals trading were not a single, isolated decision. They were the last step in a process that had been building quietly for several years. To understand this, it helps to go back to the early days of the global pandemic. During that period of extreme market chaos, something happened that many investors still remember clearly. A major Chinese bank had allowed retail customers to speculate on oil prices through a product tied to crude oil futures. When oil prices collapsed and briefly turned negative, some of these investors ended up owing far more money than they ever expected. It was a painful lesson, and it was one that Chinese regulators did not forget. Shortly after that event, Chinese banks began pausing new retail accounts connected to leveraged trading on the Shanghai Gold Exchange. At the time, this seemed like a reasonable short-term response to an unusual crisis. Few people expected it to be the beginning of something much larger. But the restrictions never fully went away. Instead, they slowly expanded. Over the following years, banks quietly tightened the rules further. Dormant accounts, ones that had not been used in some time, were gradually closed. Unused margin, the money investors had set aside to support their trades, was returned. Requirements for opening new positions became stricter, Each of these steps, taken alone, seemed minor. Together, they told a very different story. By the time recent restrictions were announced, the process had already been unfolding for years. This was simply the final, decisive move in a long and carefully managed retreat. This pattern becomes even more significant when placed alongside other decisions China has made regarding valuable resources. Earlier in the same year, Chinese authorities placed new restrictions on the export of silver, classifying it as a material with both civilian and military uses. Under these new rules, only a small, approved list of companies were permitted to ship silver outside the country. For those familiar with global trade, this was a familiar pattern. China had used a similar approach before with other important materials, including rare earth elements, tungsten, and antimony. In each case, China tightened control over resources considered strategically important, often well before global markets fully understood why. When viewed together, these actions form a much clearer picture. This is not simply a story about banking regulations or short-term market volatility. It is a story about a major economic power gradually reducing its dependence on financial systems it does not fully control. While simultaneously tightening its grip on physical resources it considers valuable for the future. For business professionals and serious investors, this kind of behavior deserves close attention. Nations rarely take these kinds of coordinated long-term steps without a clear strategic purpose. When a government slowly limits public access to speculative paper markets while also restricting the export of a physical resource, it often suggests that the resource itself is expected to become more important, not less, in the years ahead. It is also worth noting how carefully this process was managed. There was no dramatic announcement, no single moment that captured global headlines. Instead, the changes were spread out across several years, introduced gradually enough that they rarely appeared in mainstream financial news. This is often how significant economic shifts happen. Quietly, step by step, until the final piece falls into place and the full picture becomes impossible to ignore. This is precisely the position the world now finds itself in. What appeared to be a single banking decision was, in reality, the conclusion of a much longer strategy, one that has been building steadily since the early days of the pandemic, moving carefully through each stage, and finally arriving at a moment where the entire structure has changed. The question now is not whether this shift occurred. The evidence clearly shows that it did. The real question is what happens next, both inside China and across global markets that have depended for decades on assumptions that may no longer hold true. And that question becomes even more urgent once the impact on global pricing and supply is placed under closer examination. For decades, the price of silver has been shaped mostly by paper trading activity, not by the physical metal itself. Large volumes of contracts move through global exchanges every single day, with prices rising and falling based on speculation, leverage, and short-term trading decisions. Actual physical scarcity, how much silver truly exists and how much is being used, has often played a smaller role than most people realize. This matters more now than ever because, as China steps back from its paper trading system, a natural question emerges. What happens to global prices when a major participant begins relying less on paper contracts and more on physical ownership? To understand this, it helps to look at silver's actual real-world uses. Unlike gold, which is held mostly as a store of value, silver plays a critical role in modern industry. It is used in solar panel production, electronics, medical equipment, and a wide range of technologies that depend on its unique properties. This industrial demand does not disappear when markets become volatile. Factories still require silver to manufacture products, regardless of what is happening with short-term trading activity. This creates an important contrast. On one side, there is speculative paper demand, which can rise and fall quickly based on trading sentiment. On the other side, there is steady, real-world industrial demand, which tends to remain far more stable over time. When paper trading activity shrinks, this steady industrial demand becomes a larger share of what actually determines price. This leads to a concept that economists often refer to as price discovery. In simple terms, price discovery is the process through which a market determines what something is truly worth. When a market is dominated by paper contracts, price discovery becomes distorted. The price reflects trading behavior more than actual supply and demand for the physical metal. But when paper trading is reduced and physical ownership becomes more central to the market, price discovery can shift closer to reality. In other words, the price of silver may begin to reflect what is actually happening with real, physical supply, rather than how many contracts are being traded on any given day. This shift carries significant implications, particularly for business professionals and investors who rely on stable, predictable markets. Many industries depend on silver as a critical input. If pricing becomes more closely tied to actual physical availability, businesses may need to rethink how they plan for future costs, especially if physical supply becomes more limited or harder to access. Long-term supply agreements, once considered routine, may require far more careful evaluation than in years past. There's another layer to this story as well. As countries like China simultaneously restrict the export of silver while reducing paper market activity domestically, less physical silver becomes available to the rest of the world. At the same time, global industrial demand for silver continues to grow, driven largely by expanding technology and renewable energy sectors. When supply tightens while demand remains steady or increases, the pressure on pricing structures tends to intensify. For decision makers across industries that depend on this metal, these shifts are not simply abstract financial concepts. They represent real, practical questions about cost, supply chain stability, and long-term planning. A market that has operated for decades under one set of assumptions may now be entering a period where those assumptions no longer apply. This is the environment now taking shape. A gradual but meaningful shift away from paper-driven pricing toward a market increasingly influenced by physical scarcity and real-world demand. It is a shift that has been building quietly for years, largely unnoticed by those outside financial and industrial circles. And as this gap between paper promises and physical reality continues to widen, the final and most important question comes into focus. What does this all mean for the broader global economy and for those who must now navigate a market unlike anything seen in recent decades?